policy, and hence these projections essentially reflect participants' judgments about the inflation rate that is most consistent with the Federal Reserve's mandate of fostering maximum employment and stable prices. In effect, the mandate consistent inflation rate is judged to be 2% or a bit less. I turn now to the committee's economic outlook. Participants' projections for real GDP for 2011 as a whole have a central tendency of 1.6 to 1.7%. Output growth strengthened during the third quarter, reflecting in part a reversal of the temporary factors that had weighed on growth earlier in the year. In particular, global supply chain disruptions associated with the natural disaster in Japan have diminished. Moreover, the prices of oil and other commodities have come down from their peaks, easing strains on household budgets and contributing to a somewhat faster pace of consumer spending in recent months. The committee expects only a moderate pace of economic growth over coming quarters, reflecting ongoing drags from the troubled housing sector, still tight credit conditions for many households and smaller businesses, volatility in financial markets, fiscal consolidation at all levels of government, and other factors. Looking further ahead, economic growth is expected to pick up somewhat as a result of improving financial conditions, strengthening consumer and business confidence, and the continuation of a highly accommodative stance of monetary policy. Specifically, the central tendency of participants' growth projections picks up gradually from 2.5 to 2.9% in 2012 to 3.0 to 3.9% by 2014. In light of the anticipated moderate pace of economic recovery, the committee expects that the unemployment rate will decline only gradually over coming quarters. Participants' projections for the unemployment rate in the fourth quarter of 2012 have a central tendency of 8.5 to 8.7%, only about a half a percentage point lower than the latest monthly reading of 9.1%. The unemployment rate is expected to decline further to 6.8 to 7.7% by the fourth quarter of 2014, still well above participants' estimates of the longer-run normal rate of unemployment. In short, while we still expect that economic activity and labor market conditions will improve gradually over time, the pace of progress is likely to be frustratingly slow. Moreover, there are significant downside risks to the economic outlook. Most notably, concerns about European fiscal and banking issues have contributed to strains in global financial markets, which have likely had adverse effects on confidence and growth. European leaders have recently announced a number of steps to address those issues. We will continue to monitor European developments closely. I'll turn now to the outlook for inflation. The prices of oil and other commodities rose sharply earlier this year. Consumer inflation consequently picked up over the first half of 2011, reflecting higher prices of gasoline, food, and other goods and services for which producers passed higher input costs along to their customers. In addition, prices of motor vehicles surged in response to the global supply disruptions associated with the disaster in Japan. However, inflation appears to have moderated as those transitory influences have waned and as low levels of resource utilization constrain rises in prices and wages. Furthermore, survey measures and market indicators imply that longer-term inflation expectations have remained stable. Consequently, the committee anticipates that over coming quarters, inflation will settle at or below its mandate-consistent rate of 2% or a bit less. Specifically, the central tendency of participants' inflation projections is 2.7 to 2.9% for this year, but declines to 1.4 to 2.0% in 2012 and remains subdued through 2014. The committee will continue to pay close attention to the evolution of inflation and inflation expectations. The current economic outlook provides important context for understanding today's policy decision. The committee's mandate from the Congress is to seek maximum employment and price stability. With unemployment well above normal levels and expected to decline only slowly, and with inflation expected to remain at or below mandate-consistent levels, the committee decided today to maintain the current high degree of monetary policy accommodation. We will continue to assess the economic outlook in light of incoming information, and we are prepared to employ our tools as appropriate to promote a stronger economic recovery in a context of price stability. Finally, I would like to note that the committee strives to explain its monetary policy decisions as clearly as possible, and we continue to explore ways of enhancing the clarity of our public communications. Specifically, we have been engaging in a series of discussions about potential approaches to providing the public additional information about our monetary policy goals and policy strategy, as well as about our outlook for the economy and for the future stance of monetary policy. However, no decisions about such approaches were made at this meeting. Thank you for your patience, and I'd be happy to take your questions.
Mr. Chairman, over the past several months, it seems there's been increasing criticism of the Fed's policy. You received a letter on the eve of the September meeting urging you not to take action from the GOP leadership. Several GOP presidential candidates have criticized Fed policy in the debates. On the first issue, do you feel that crossed the line? Was it appropriate in the context of the Fed's independence? On the second question, what are the GOP presidential candidates not hearing or understanding about Fed policy, in your opinion?
Well, politics is politics, and the Federal Reserve tries to stay nonpartisan and out of those debates. I mean, our job is to do the best we can for the U.S. economy, to do what we can to promote our mandate of maximum employment and price stability. And although we must be accountable to Congress over the longer term, in the short term, it's very important that the Fed be free from political pressures. And therefore, we're going to make our decisions based on what's good for the economy. We're not going to take any politics into account. Now, the concerns that have been expressed relate to the possibility that the Fed's highly expansionary policies might be contributing to inflation risk. I would simply point to the record. If you look back for the last 5 years, inflation, although it's been volatile because of commodity price fluctuations, has averaged about 2%, which is close to a reasonable definition of price stability, whereas the area where we have fallen short, obviously, is on the unemployment side. So I think that criticisms based on the concern about inflation have so far at least not proved to be very valid. Well, I'm not going to comment on that. We listen to everybody's input, and the most important thing is that we are free to make the decision based on the interest of of the American people and the interest of the economy. And that's what we're going to do.
Has the Fed discussed the idea of nominal GDP targeting, and what are your views on the advantages and disadvantages of that approach?
So the Fed's mandate is, of course, a dual mandate. We have a mandate for both employment and for price stability, and we have a framework in place that allows us to communicate and to think about the two sides of that mandate. We talked today, or yesterday actually, about nominal GDP as an indicator, as an information variable, as something to add to the list of variables that we think about, and it was a very interesting discussion. However, we think that within the existing framework that we have, which looks at both sides of the mandate, not just some combination of the two, we can communicate whatever we need to communicate about future monetary policy. So we are not contemplating at this time any radical change in framework. We're going to stay within the dual mandate approach that we've been using until this point.
Go to Jen here, and then over to John.
Chairman, you've said in the past you understand some of the anger on display with the Occupy Wall Street protesters. And a lot of the anger is directed at the Fed, with some protesters saying that the Fed is part of the problem, that the Fed preserves the financial system and promotes income inequality. Are the protesters right? Is the Fed part of the problem? And secondarily, can the Fed do anything to promote a more equitable economy?
Well, as I've said before, I certainly understand that many people are dissatisfied with the state of the economy. I'm dissatisfied with the state of the economy. Unemployment is far too high. Inequality, which is not a new phenomenon, has been going on. Increases in inequality have been going on for at least 30 years, but obviously as that has continued, we now have a more unequal society than we've had in the past. So again, I fully sympathize with the notion that the economy is not performing the way we would like it to be, and in that respect, the concerns that people express across the spectrum are understandable. I think that the concerns about the Fed are based on misconceptions. The Federal Reserve was involved, obviously, in trying to stabilize the financial system in 2008 and 2009. A very simplistic interpretation of that was that we were doing that because we wanted to preserve, bankers' salaries. That is obviously not the case. What we were doing was trying to protect the financial system in order to prevent a serious collapse of both the financial system and the American economy. We needed to take those steps. If we hadn't taken them, the consequences would have been dire. And not everybody understands that, and therefore they sometimes misunderstand our motives. Our motives are strictly to do what's in the interest of the broad public, and I believe that our efforts to stabilize the financial system, which ultimately proved successful, were very much in the interest of the broad public. With respect to the current economy, as I described earlier, we are currently continuing with our accommodative monetary policy. We are trying to do our best to support economic growth and job creation. I think it would be helpful if we could get assistance from some other parts of the government to work with us to help create more jobs. But certainly we are doing our part to try to create more jobs and more opportunities in America. With respect to inequality, I think the best way to address inequality is to create jobs. It gives people opportunities, gives people a chance to earn income, gain experience, and to ultimately earn more. But that's an indirect approach. That's really the only way the Fed can address inequality per se.
John, and then we'll go to Pedro, and then over to Greg.
John Helsenoff from the Wall Street Journal. Mr. Chairman, the Fed's forecast for 2013 shows the unemployment rate finishing the year between 7.8 and 8.2%. The statement says that short-term rates will stay near their current levels at least through mid-2013. Does that suggest that the Fed could conceive of raising short-term interest rates before unemployment even gets to 8% or much lower? And if not, could you explain how people should interpret those two messages?
Well, the statement says at least mid-2013. So clearly it could well be some point beyond that, and markets are currently anticipating a somewhat later liftoff. One of the things we discussed yesterday in our communications discussion was how we might further clarify that part of the statement and try to provide more information about what conditions would prevail at the time that we would be considering raising rates. But we haven't come to that point yet, but we certainly would like to provide more clarity about that. But again, let me emphasize that what we are saying now is at least. There's no implication that we would necessarily move in mid-2013 with those conditions prevailing that you described.
I'm Pedro DaCosta from Reuters. Mr. Chairman, what is your appetite for a renewed push into large-scale mortgage-backed securities purchases? The Fed had stated the intention to move the structure of its balance sheet more to its original, treasuries-only composition. But recently it revived the MBS program through the reinvestments, and folks like Governor Tarullo and William Dudley have raised the possibility of further large-scale asset purchases on the MBS side. Could you comment on your views on that particular proposal?
Yes, I'd be glad to. You were absolutely correct. First, that ultimately we would like to return our portfolio to treasuries only. That may be sometime down the road at this point. You're also correct that as part of our policy action at the last meeting, we began to reinvest mortgage-backed securities and agency debt back into mortgage-backed securities, thereby providing some additional support for the mortgage market. The housing sector is a very important sector. The problems in that sector are clearly a big reason why our economy is not recovering more quickly. So I do think that purchases of mortgage-backed securities is a viable option. It's certainly something we would consider if conditions were appropriate. So the answer is yes, we would certainly look at that.
Thank you, Mr. Chairman. Greg Robb, MarketWatch.com. At the moment now, banks are holding hundreds of $billions in excess reserves, and at the same time, corporations seem to be holding lots of cash on the And foreigners, at the same time, foreigners keep investing a lot of money in the United States. Current account deficit is very large. Could you shed some light on that situation? Is there something the foreigners know that U.S. companies don't about investing in the U.S.?
Well, a great deal of the investment in the U.S. takes the form of purchases of U.S. government debt, Treasury securities, and that in turn reflects the desire for the liquidity and safety provided by the U.S. Treasury market. For example, as you know, two of the largest holders of U.S. Treasury securities are China and Japan, who hold those securities primarily as foreign exchange reserves, and in the case of China, in an effort to keep their exchange rate from appreciating too quickly. So it's good that foreign central banks and so on have the confidence to buy U.S. Treasuries, it's not quite the same as investing in plant and equipment. We've seen a little bit of improvement there, but it's still obviously too low to be consistent with the full employment economy.
Peter Barnes, Fox Business. Sir, could you comment on the failure of MF Global, which is a primary dealer, and specifically the Financial Times is reporting that the leverage ratio at MF Global was 40-1. Were you aware of that? Did the Fed approve of that? Is that an acceptable leverage ratio, particularly since the financial crisis?
Certainly. The New York Federal Reserve Bank approved MF Global to be a primary dealer, I believe it was in February of this year. At that time, the company met the criteria that had been set forth in terms of management, financial condition, capacity, and so on to qualify to be a primary dealer. We have set those standards in a way that would allow smaller firms like MF Global to participate in the primary dealer market. But I'd like to emphasize, I guess, a couple of points. First, we are not the regulators of MF Global. That's done by the SEC and the CFTC. So we do not have ongoing insight into developments within the company. And secondly, again, making them a primary dealer did not in any way constitute a seal of approval. In fact, the New York Fed's website contains a statement pretty much to that effect. So they were a primary dealer. We stopped trading with them before they failed, and we've suffered no losses or other consequences from our transactions with the company. Again, in terms of your question about leverage and financial condition, the company declined very, very quickly based on apparently a small number of large bets. As far as I know, we were not aware of that, but again, to emphasize, we are not the overseers, the regulators of that company. The question is, was that an isolated case? It appears to be an idiosyncratic case, and we're monitoring the possible impacts on funding markets and elsewhere, and so far we've not seen any significant impact on financial stability.
Just to follow up on that question, should the Fed be on an ongoing basis monitoring its primary dealers?
The question is, should the Fed be monitoring its primary dealers? Only if the Fed is the supervisor. In this case, the combination.
All right. So there is where the pop that happened a little bit on that uptick, and I'm going to conclude it. There's more to the video. It's called FOMC Ben Bernanke.